Before we begin, if you value calm, clear, noise-free explanations about how the world really works, take a moment to subscribe. It helps the channel grow, and it keeps this kind of content alive. Every few years, the world holds its breath. A headline appears, markets fall, people panic, and commentators say the same familiar words. No one saw this coming. But what if that's not true? What if crashes don't come from nowhere, but from a cycle that has been repeating for more than 100 years? Today, we're going to walk through that cycle, slowly, clearly, one layer at a time. And by the end, you'll understand why financial crises never truly end. They only reset the clock. This is Financial Room. Let's start with a simple truth. Markets don't move in straight lines. They move in cycles. Expansion, euphoria, instability, collapse, and recovery. This pattern is so old, you can trace it back through every major event. The Great Depression, the dot-com bubble, the 2008 financial crisis, even the mini crashes that barely made the news. Different decades, different technologies, different governments. Same cycle. To understand why, we need to look at the three forces that silently drive every crash. First, the credit cycle. Second, the psychology cycle. Third, the liquidity cycle. Think of these as three gears turning beneath the surface. Individually, they're powerful. Together, they create the rhythm of modern capitalism. Let's begin with credit. Because modern economies don't run on cash, they run on borrowed money. When credit is cheap, people borrow more. Businesses expand, investors take risks, governments spend freely. The economy grows, quickly. But credit doesn't stay cheap forever. Rates rise, debt becomes heavier, cash flow tightens, and suddenly, the very thing that fueled the boom starts feeding the downturn. Every crash in modern history has roots buried in credit conditions. It's not the headlines, it's not the politicians, it's not the tweets, it's the cost of borrowing and the pressure it puts on the weakest points in the system. Next, psychology. Because markets aren't made of numbers, they're made of people. People who feel fear and excitement, people who follow crowds, people who chase returns and flee losses. In every boom, you see the same emotional arc: optimism, confidence, excitement, and finally, euphoria. Euphoria is the most dangerous part, not because people are irrational, but because they believe this time is different. And then something small happens: a missed earnings report, a political announcement, a rumor, a default in a company no one cared about. And suddenly, confidence flips. Fear spreads faster than optimism ever did, because loss hurts more than gain feels good. Now, the third gear, liquidity. This is the oxygen of the financial system. When liquidity flows, markets stay alive. When it dries up, everything suffocates. Banks tighten lending, investors hoard cash, businesses delay hiring, people spend less. Liquidity is the shadow force. You rarely see it in the news, but you always feel its consequences. Crashes happen when all three forces align in the wrong direction. Credit tightens, psychology weakens, and liquidity disappears. When one gear slows, the others can keep the system moving. But when all three turn downward, the cycle snaps. That's why crashes feel sudden, even though the pressure builds quietly for months, sometimes years. And here's where it gets interesting. Because the cycle doesn't just stop at collapse. There is another phase, a phase that almost no one talks about. A phase that determines who survives the crisis and who rises from it stronger than before. We'll explore that in part 2. When a crash finally hits, it feels like the world is ending. Markets fall, jobs disappear, confidence evaporates, and the same question repeats itself everywhere. How long will this last? But here's the part almost everyone misses. A crash is not the end of the cycle. It's the beginning of the reset. Every crisis exposes the system's weakest points: the over-leveraged, the overconfident, the companies built on hope instead of revenue, the households stretched thin by cheap debt. During expansions, these fragile parts survive because the system carries them. Banks keep lending, investors keep buying, consumers keep spending. But when the tide goes out, the system stops carrying anything. And this is painful, but it has a purpose, because clearing out weak structures is what allows strong structures to rise. After every crash, governments and central banks step in, not because they want to, but because they must. They inject liquidity, they cut interest rates, they stabilize markets, they create new rules, sometimes good, sometimes bad. This intervention phase is the bridge between collapse and recovery. It doesn't restart growth instantly, but it stops the bleeding. And then, slowly, quietly, rebuilding begins. People adjust, businesses adapt, markets revalue, new opportunities emerge. This phase is never dramatic. You rarely see it on the news. But it's the moment when fortunes are built, not during the boom, but during the quiet, uncertain, patient months that follow the crash. Because prices are low, competition is lower, and the system is resetting its baseline. So why doesn't this cycle ever stop? The answer is simple. Because humans don't change. We fear losses, we crave gains, we follow crowds, we overextend, we tell ourselves stories about the future, stories that feel true until they aren't. Credit expands, optimism rises, liquidity flows, and the cycle begins again. The names on the headlines change, but the underlying mechanics never do. Now the real question: what does this cycle mean for you? It means that crashes are not moments of pure destruction, they're moments of redistribution. Wealth doesn't disappear in a crisis. It moves, from weak hands to strong hands, from leveraged positions to liquid ones, from panic to patience. Understanding the cycle allows you to stop reacting emotionally and start positioning strategically. Because the people who get hurt most in crises are not the ones who know least, but the ones who prepare least. So here's a simple framework used by analysts, hedge funds, and institutional investors to navigate cycles calmly. 1. Watch credit conditions. If borrowing becomes harder, the cycle is tightening. 2. Watch psychology. If optimism turns into euphoria, a correction is coming. And if fear feels overwhelming, opportunity is beginning. 3. Watch liquidity. If liquidity dries up, risk rises sharply. If liquidity floods back in, recovery is starting. These 3 signals tell you more than any headline ever will. Here's the deeper truth. Crashes aren't the malfunction of capitalism. They are the maintenance. They clear out excess. They correct distortions. They remind us that nothing grows forever, and nothing collapses forever either. The cycle keeps turning, because the cycle is the system. If this helped you understand the world with more clarity, stay close. We explore hidden economic mechanics every week, calmly, clearly, and without noise. Welcome to Financial Room.